Okay. The topic income of a non-lessor from shipping and aircraft. Just wanted to understand how many of you are having a background of shipping. If you could raise the hands, so accordingly then I can space my sessions. Okay, none. That's great. So less questions. Okay. So I'll just take you through this entire thing. What we'll be covering is primarily taxability under the Income Tax Act, taxability under the treaty, and there are some things like, if you go under the treaty, the concept like international traffic, pooling arrangements, and the cases which are decided by the court in the context of shipping. Now let's go, these are the terms which are used: foreign airline, shipping companies, Income Tax Act, OECD, POEM, and UN. Now let us go to the Act. What does the Income Tax Act, and how is the Income Tax Act talking about taxability of a foreign shipping company? If you look at it, Income Tax Act talks about foreign shipping companies and aircraft. They both are clubbed together. That is under the Act also as well as under the treaty. So in the Act, if you see, there are two sections talking about foreign shipping companies. It talks about 44B and 172. And then as regards the aircraft, if you look at it, it is 44BA. Now, what does this section talk about? Are there normal computation mechanisms? No, this purely is a section which talks about a presumptive taxation. So, a flat amount of the freight received is taxed under these sections. And what could be the purpose behind taxation like this? The reasons could be because a ship is moving or an aircraft moves from one country to another country, so you can't be taxing under the normal provisions. Hence, under the Act, as well as under the treaty, there is a separate article talking about taxability of the shipping companies and the airlines. Now, I have just tabulated out here what is the difference in my earlier slide. You see there was a shipping company has to be taxed under 172 as well as under 44B. So what's the difference? Is there any difference in the, or can a assessing officer tax you under both the sections? Does he have the power to tax under 44B as well as 172 or only under 172, and how do you distinguish? So if you look at it, before that I will just take you through, I think, what is 44B talking about. If you read 44B, what it says is special provisions for computing profits and gains of shipping business in case of a non-residents. And what it says, you just see the comparison between 44B and 172. 44B says, notwithstanding blah blah, assessee. So it starts with an assessee who is a non-resident and engaged in the operation of ship. In that situation, a sum of 7.5% of the money received by him as defined under subsection 2 will be taxed. Now, what is that amount received? If you go to subsection 2, clause 1, it says the amount paid or payable to the assessee or to any person on his behalf on account of carriage of passengers, livestock, mail, or goods shipped at any port in India. So what this basically means is, goods shipped at a port in India, it would mean export freight. If I am exporting the goods from India and the goods are shipped in a port, at a port in India and the goods are going out of the country, so clause 1 talks about export freight, and clause 2 talks about amount received or deemed to be received in India on behalf of the assessee on account of carriage of passenger, blah blah blah, or goods shipped at any port outside India. So if you look at it, the difference in clause 1 and clause 2. Clause 1 is export freight, clause 2 is import freight. So the only difference if you look at it in clause 2 is it talks of received or deemed to be received. So effectively, if any import freight is collected outside India, it will not be taxed under 44B. This is what is there. And then they refer to the explanation. It talks about demurrage charge of handling or any other amount of similar nature. This is primarily to cover, in the shipping industry there are many inland haulage charges, you have terminal handling charges, documentation charges, there are many receipts you collect. So earlier the stand taken by the SSC was that this is not in the nature of freight, hence it should not be taxable. So to overcome that, this was the explanation which was inserted, I think in 1976, to bring out the point that demurrage, handling charges or any other amount you should receive will be considered like freight and assessed under 44C at the rate of 7.5%. So this is all about 44B. Now let us look at 172. Now what this section says. I have underlined the portion notwithstanding anything contained in any other provisions of the Act. I'll touch upon that later on to ask a question to you. So what this section says is, for the levy and recovery of tax in the case of a ship belonging to or chartered by a non-resident, which carries passenger, livestock, lava, again shipped at a port in India. This again talks about export freight. Shipped at a port in India and export freight. So but if you mark the words, it talks of a ship belonging to. So it doesn't mean that the SSC is taxed. In 172, what is taxed is the ship. Every ship which comes to India, at the time of leaving the India, there are certain formalities to be done, and a return has to be filed for each ship. And if you go to other section, if you look at, and the computation mechanism is more or less similar like 44B at the rate of 7.5%. And if you look at subsection 3, what it says is that he has to, every master of the vessel has to file a return. Now in practice what happens is that the master of the vessel never files a return, he gives a undertaking or not undertaking, I would say, it's a letter of authority or authorization to the people who are doing the shipping business in India, probably a CHA sort of a person, who would file a return on behalf of that foreign ship. And in that return, he will say, okay, my income from the export rate is 7.5%, and that is how we compute, and if it is liable to taxation, he will pay, otherwise claim the treaty benefit. So this is what it says. Now let us go to the other section. What it says is, on receipt of the return, so what subsection 3 talks about is, I have to file the return within 30 days after the departure of the ship. And in subsection 4, on receipt of the return, the AO has to determine the sum payable thereon at the rate applicable force. That's fine. Then go to subsection 4A. What subsection 4A says is that after the return is filed, the assessment has to be made of that particular ship. And that assessment, if you see, has to be made within 9 months from the end of the financial year when the return is filed. Suppose you filed the return in the month of January 2017. So before September 17, the assessment has to happen of that particular ship. And if you look at it, this section, which was not there earlier. So I'll tell you my experience. This section came in somewhere, if you see, the proviso. No order shall be made on or before 31st of December 2008. This proviso was inserted because earlier there was no time limit mentioned. So this time limit concept has come in. And I had a case where in 2000, I would say, I think 9 or 10, 100 vessels had come to India. The tax officer had made 100 assessments. And in that particular year, I would say, thousands of assessments were made just because to comply with the timeline of 9 months. Otherwise, and that resulted in a lot of complication in terms of an assessment under 172 being done, and parallelly assessment under 44B also, right, with section 143.3. So this is slightly a challenge in terms of what assessment should be done, 172 or 44B. Now go to subsection 7. Subsection 7, what it says is that if you are, before that let me just go to the heading of shipping business. What it talks about 172, if you look at it, it says, in fact I have not put the heading. The chapter heading is shipping casual, in casual business. If you are in the casual business of shipping, then 172 applies. Normal shipping business is 44B. Now subsection 7, what it says is that, assuming that I have filed a return and I want to be assessed under the normal provisions of the Income Tax Act like 44B read with 143.3, I have to exercise the option under subsection 7 and intimate the tax officer that I don't want to be governed by 172.4 assessment but under the normal provisions. So that you can exercise under subsection 7. So if you look at it, the distinction between 172 and 44, assessment of the ship, assessment of the SSC, and if I am being assessed as a ship, I have the right to say that no, assess me as a SSC under the normal provisions and I will be governed by the normal provisions like he'll issue a notice under 142.1, normal 143 assessment will happen. So this is broadly the distinction between the two. Now let us come to this is what I have written. If you see, 44B applies to a regular shipping business, 172 applies to occasional shipping. If you look at it, 44B overrides 28 to 43A and 172 overrides all other provisions of the Act. Now this, what I mentioned, all other provisions of the Act. Question before you, which I'll take up later on. So one of the questions which you may have to address is, if I am coming from a treaty country, can I claim the treaty benefit or not? Does 172 overrides all provisions of the Act? So effectively, does it mean that section 92 also is overridden by 172 or not? So what is the answer? Act, etc. you are aware, treaty you are aware. Let us, before we go to Article 8, the 172 section says it overrides all of the provisions of the Act. Under the Act you have 90 small 2 also, subsection 2. So what do you feel? Does it override 92? Can you say that I cannot claim the treaty benefit because I am filing a return under 172? This is a basic question under the Income Tax Act. And I have shown you the section 172, what it says. So what is the feeling of the audience here? Yes or no? How many say yes? It overrides 92. So two people are there. What about you, madam? Does it override or not? It doesn't override. So majority feel it doesn't override the Act. But the section is very clear, notwithstanding anything containing any other provisions of the Act. So it overrides, isn't it? Should I go back to the section again? Notwithstanding anything containing other provisions of this Act. So effectively, doesn't it override the Act? Override 92 also. Maybe we'll touch up this later on. People are don't want to take a decision perhaps. Okay, let's go to the other part. So what is the difference if you see? 44B talks about income deemed at the rate of 7.5% on the export freight wherever received. Here you see export freight is covered both the places. Now come to import freight received in India. On this side, import freight is to be excluded. And the other part like freight to include demurrage, handling, etc. This is quite similar to what is there in the 172 and 44B. Here you have to file a return within 30 days of the departure of the ship. Here you have to file the return under 139 like a normal SSE. And normal procedure for tax assessment, here the time limit is 9 months. So this is broadly the distinguishing factor between 172 read with 44B. So effective tax rate, if you look at it, what it means, because the foreign company is taxed at the rate of 40%, so on the freight income earned of $100, I have to pay a tax effectively of 3%. It sounds very small, but if you look at the shipping industry for the last, I would say what, 2007 onwards, they are doing really bad. So even this percentage of 3% could be a huge amount which can affect them significantly. And that is the reason if you look at it, the shipping industry, most of the top mercs and one more I think, there is a merger happening among the shipping lines to ensure that they can at least carry on the business. And there is one more I'll tell you. When I was handling one of the cases in Ahmedabad, there was an investigation by the department and sort of a report which was called for by the ministry from the tax officer, from the commissioners, to the effect that the freight remittance from India was much higher and claimed exempt under the treaty as compared to the freight shown by the non-resident companies in the tax return. And that anomaly was very huge. So in that process, what happened is that lot of the assessments, there was a lot of confusion in the mind of the tax department, and they were questioning as to whether you are really eligible for treaty benefit or was there a treaty shopping. And I had the occasion to handle a couple of cases where two things happened. One is, as I told you, 100 or 150 block assessment under 170. Lot of orders being issued. In spite of the fact that I am being assessed under normal provisions, I am filing my returns under 141, under 139 and that is 143.3. So here is the demand under 172 and normal assessment time limit is available because you have a time limit of 2 years. Here it is 9 months. So that was the challenge. And because of the letter from the CBDT, lot of shipping companies are asked questions as to justify that you are eligible for treaty benefit. Say you come from Dubai. Is there an operation in Dubai? Are you carrying on any activities there? So the substance test per se was getting questioned at that time. So now let us look at coming to the foreign airlines, it is more or less similar to, I'll just take the two. What does it talk about? Here what it says is that special provisions for computing profits of aircraft in the case of a non-resident engaged in operation of aircraft, the sum equal to 5%. So as against 7.5% for a shipping line, it is 5% out here. And rest of the things are more or less similar, so we will not discuss this right now. So only the difference is a shipping company under the Income Tax Act at 7.5% presumptive taxation and an airline 5%. Here the effective tax rate is 2%. Now let us look at, you have understood the section, what is 172, what is 44B. Let us look at some questions, and this could be more of an interactive session, I would say. The first question is whether the above presumption provision would applicable even in case of losses. What is your answer? You think and let me know. Based on the normal tax provision which you apply in the case of presumptive taxation which you have under 44D and all that, do you feel above presumption provision should be applicable in case of losses? Say a foreign company says that, okay, I am incurring losses, I am not earning any profit, though my ships are coming into India. Can I say that, and hence I should not be paying taxes? Yes or no? No. So, and what is the reason for no? Yeah, so you have a decision out here in the case of Royal Georgian Airlines to be applicable in the case of losses. Here it says no. The reason, of course, this is a very unique decision. Overall, if I am incurring losses, where is the question of being taxed under this provision? Now let us look at the other. Are provisions of 44 be applicable to domestic air traffic? Because I told you, foreign shipping, non-resident carrying on shipping business, airline carrying on airline business, non-resident, under 44 double BJ. So what is your opinion? Does this get covered? 44B applicable to domestic. Suppose British Airways operates in India only. Will they be eligible for the benefit of 44B and get taxed only at 4%, at 2%? What is your opinion? Yes or no?
No.
Why no? Because if you really look at it, the definition of 44BB as well as this 44B and 44BBA talks about a non-resident engaged in shipping business and airline. It doesn't use the word international traffic, which is there under the treaty, not under that. So from that perspective, you may take a proposition that it's applicable also to a domestic air. Now the only challenge which you will have is that suppose I do a 100% domestic airline, that may not work for us. Because the objective is to ensure that if you are carrying on shipping business, not totally, then you are resident in India and then virtually as a fixed place of fee you will be taxed. But otherwise there is a probability depending upon the percentage of domestic traffic what you undertake as compared to the international traffic. And you have a decision of Lloyd's helicopter in that regard. Third aspect is whether income arising from outside India is also taxable under 44B. Here you have the decision. If you remember, I had spoken to you about under 44B, it is a freight, import freight received in India. So if I receive the freight outside India, logically that can't be taxed. In fact, I have yesterday only appeared before appeal. It was an interesting issue. It was, I think, a German company having more than, I think, 25-30 vessels coming into India. Around 5 vessels came to India, but only to drop the cargo, did not carry the cargo. And in the shipping line, you are supposed to obtain a double income tax relief certificate, which you get at the start of the year. So because for those ships, DIT was not obtained. So logically, the tax department says that you don't have a DIT, which you should obtain at the start of the year, and you did not file any documents, hence I am not allowing the treaty benefit. So here was a situation where 15 vessels come of the same person, having a tax residency certificate allowed, and this was never offered. I didn't offer the income for taxation because it was only to drop the cargo and not to collect the cargo. So hence, it was the import freight, that too, to the extent of the import freight collected in India, I offered for taxation, not and collected outside India, I did not offer. So ultimately, was the hearing, I think the appeal, he said what he said right, but this is what normally happens in the course of the assessment in terms of if your documentation etc. is not proper and not given to the tax department at time. So this is one. Now go to the fourth one. Whether assessment of a non-resident ship owner under 172 can be said to be assessment of his income. Again, shall I repeat the question? Whether assessment of a non-resident ship owner under 172 can be said to be assessment of his total income. Why? Why? Yeah, because what happens is that 172 talks about the ship, not the non-resident assessee. And here, again, in spite of that, there is a decision that you see. So that can make you understand that if the section is so clear, still there is a confusion in the course of the assessment, and that matter reaches the tribunal. Now, disallowance. This is now because I am a presenter taxation. If there is a disallowance, assume for a moment. Of course, this is not relevant from a non-resident company perspective, but just I am assuming that a non-resident is having a PE in India, and then these sections do apply. So whether a disallowance under 14A, 40A, etc. can be made over and above 7.5%. Directly it is not applicable shipping, but I am just bringing it in perspective because in the Indian context, if a company, Indian shipping company under the joint tax scheme, they are also like a presumptive taxation. So hence the question arises whether disallowance can be made or not. So what's the answer?
No.
Why? So these are the practical. So you have a case law for that. Share shipping said that no, you can't make a addition just because it is presumed that 7.5% all the expenditure is allowed to the assessor. Now let us, okay, the other question is whether debt freight can be treated as payment on account of carriage of goods. Are we clear on what is debt freight? I think that was the question. Debt freight would mean that I engage with the shipper to carry the cargo, but I am not in the position to carry the cargo, so I am paid compensation. That is called debt freight. So now because I have a contract with you, as per the contract I am supposed to carry cargo from India to say Singapore. Due to some reasons the cargo is not ready, whatever. But you had engaged my services, so you pay me some percent, some whatever. That the percentage or whatever the compensation could be about different nature, that may be commercially decided. But principally, is it eligible for 172 or not? It could be a 44B also. Yes or no? Why?
It is conducted during the business law.
What? Okay. I'll tell you the answer. This is the decision. It says no. The reason is you are given freight is for carriage of cargo or carriage of passengers. Are you carrying anything? So hence you will not get it. Now does 172 override 44B? Yes. So how do you work on that? Means there is a, do you think if I am filing a return under 143 on 139, so and 172 is there, what happens then? But if you look at it, okay, let us give, what is the reason for it overriding? Let's understand that. Why it overrides? Because if you see 172 talks about ship, not the accessee, then it doesn't override. This is a decision in that respect. Whether 92 overrides section 172? Yes or no? If you see, we read 172 is not understanding anything contained, so logically 172 should override 92. So now you have the right, you have to answer now. What's your answer? Yes or no? You had breakfast in the morning, so you can now answer. Chamber has been kind enough to provide breakfast, isn't it? Okay. What's the answer? See, let it be an interactive session. Then you enjoy. Why I have picked up all these cases is reading of the section is very simple, but when you really apply the section, in reality, you have to understand the provisions. Here you have a decision. It's a High Court decision of Gujarat. It said that it overrides. Though technically speaking, if you see, notwithstanding anything contained means 172 overrides everything in the Act. But if that was the case, the purpose of entering into a treaty with a country gets totally failed. Hence, this decision is in your favor. Would income from wet leasing of an aircraft considered as business or operation of aircraft? Now, what is wet leasing? Are we aware about wet leasing and dry leasing? So, aircraft is provided, say, through Air India by, say, Boeing on a wet lease. Means they will provide the aircraft, they will provide the manpower, and they will manage technical everything. So, in this case, an airline is owner of an aircraft provides a wet lease to Air India for the purpose of the business, and it says that no, my income is from the shipping under 44BA, and hence under that or under Article 8 of the treaty I am exempt. Is it right or not? This is the decision which you have. The answer is no, because what is happening in this case is that I am having an aircraft, I am giving out lease, I am not operating or earning income by virtue of the link to the carriage of passengers. The entire responsibility was of Air India in this case, because Air India is issuing a ticket, Air India is ensuring that if there is a loss, etc., who will compensate? Air India will compensate, not carriage check. So this is the decision. Now, the other questions here, service tax should be considered gross receipts for purpose of 44B and BBA or not? Because very often in the shipping you have element of service tax getting added, as you have in the case of tax audit. If you are a professional, you add service tax. The question is whether service tax is part of my, especially in those on the borderline cases for tax audit liable or not liable. So in this case also, that issue is not there. But if I am earning an income, say 50 crores or 100 crores in India, and I tell you there are the amount of freight etc. is huge. 700, 800 crores I have seen returns filed where they claim exemption, but that is the amount of income they earn. Some element of service tax, it could be some crores of rupees. So what's your answer?
No.
Why? So here, there's not. Here you have two decisions. The first decision says it should be included of the Bombay Tribunal. The second decision says it should not be included. So there is a divergence of view on this particular point. And I think you have the Sudhir Chemicals Bombay High Court decision on that. Now, multiple assessments, assessment under 143 or 172. Can there be multiple assessments or not, which I have already told you in the morning? So it is right or wrong? There is no section in that which says that you cannot do it. They have the right to do it. And assume, I'll give you another situation. Assume that I file the return but there is no assessment happening in my case. The situation is there, 143, one I get, no notice is issued for scrutiny for the foreign shipping line. But they do 172 assessments, and later on maybe they feel that there is some income which is escaped assessment and they do reassessment under or a reopening under 143, 148 for the normal assessment. What will happen? Can there be a disassessment or a protective assessment under 148 and a normal assessment under 172? What's your view? Yeah, think. Fast. There can be no multiple assessments. The answer is not possible. I had a case in the Rajkot Tribunal, similar issue had happened. I was filing a return in Bombay, vessels were in Rajkot or in that Gujarat. I said 100 assessment happening there. So we said that you can't do assessment there as long as I am assessed under the normal provisions. So the tribunal held that yes, you cannot do it. Now, is it possible to access the India-UA tax treaty where shareholders of the company are from Switzerland, which grants right to tax shipping income to Switzerland? I'll just explain this case to you. A Switzerland company, a resident set up a company in UAE and for the purpose of shipping, and UAE is earning income from India. So basically India-UAE treaty applies or India-Switzerland treaty applies, and under the India-Switzerland treaty there is no article 8 is there, it goes only aircraft, not shipping. So now what is the answer? And the tax officer said that you cannot claim India-UAE treaty benefit, but only the, because they said that they are, if they were to come directly from Switzerland, article 8, they would not have got the benefit because there is no article on shipping line, foreign shipping line. This is what he said. But they claim under the India-UAE treaty because UAE was a company which they formed and that was earning freight from India. So is it right or not? Could they access the treaty, or what the AO did is right by saying that no, you cannot access the treaty because in the India-Switzerland there is no article 8 covering foreign shipping lines. Later on in 2011 it got modified. So what's your view? Yes or no? AO is right. Okay, and you say he is right or no? No. So is it divided opinion? So, okay, yeah. See, this is a decision which said that yes, he can access the treaty. Because what it said is that the reason given by the assessing officer for not accessing was that because you are a resident of Switzerland and you are accessing the treaty through via UAE. And he went under the limitation of benefit clause under Article 29 to say that I will disallow or ignore the India-UAE event. So this is another potential risk of freight forwarder being considered as agent of non-resident. There are a couple of decisions in this regard. I just brought out this point because though directly it is not relevant to a non-resident company, but a lot of agents operate in India on behalf of the foreign shipping line, and there is a possibility of they being considered as agents and getting taxed. And there are a couple of court decisions which say that okay, agent may earn say out of $1,000 even $10, but the liability of the foreign shipping line can fall on him. One of the reasons is if you read 173, the return which you file, by and large the return is filed by the agent in India because the foreign ship comes, the power of return is given by the captain of the ship to the Indian agent, and the ship goes. Hardly 2-3 days the ship is there, it goes. So effectively there is a huge risk if the compliance is not done by, or the agent doesn't take care of all the documentation you require vis-a-vis the foreign shipping line. So this was all about around 13 different instances I have shared with you on how do you interpret 44B Remit 172. Now come to the treaty. Now what is the objective of instead of this article is to restrict the rights to one contracting state only. An exception, there are some exceptions where both the countries have the right to tax with some concessions. Then is to simplify the taxability of for the non-resident operating. Fragmented taxation can be a burden, hence needs to be mitigated. Mitigate the burden of profit attribution, because if you go to the treaty, this is covered under Article 8 and there is an exclusion out of Article 7. Overrides Article 7 and no need for detailed rules since taxing rights restricted to only one state, and there are again in the treaty also there are plethora of issues on interpreting Article 8, which I will come to that. Now let us look at what does Article 8 talk about. What does Article 8 say? Profits from the operation of ships and aircraft in international traffic shall be taxable only in the contracting state of which the enterprise is a resident. So effectively it means if a German shipping line or a German airline operates in India and on freight, the right to tax is with Germany, not in India. And then they are defining what is the term profit shall include derived from the enterprise from the rental of ships and aircraft operated. And there is various, if you look at it, maintenance. This treaty, India-Israel treaty is very, very unique in that sense. Because if you look at it, various terms which are there. Rental of ships and aircraft operated in international traffic. Such term also includes income derived by the enterprise from the use, maintenance, rental of containers operated in international traffic. If such income is incidental to the profits of the enterprise from the operation of ship. So, if you see the terms, one is operation of ship is a term under Article 8. Second is profits derived by the enterprise, something like rental income is covered, rental from containers is covered, and incidental to the profits of the enterprise. And subsequent, if you see Article 383, it talks about participation in a pool, a joint business, or an international operating agency. So if a shipping line is a part of that, that also income is eligible under Article 8. Then you have interest on funds connected with the operation of ships or aircraft. This is quite unique. Majority treaties don't have this clause on interest. So assume a situation you want interest on income tax refund. Whether that will get caught under the article or not becomes the question. Then operation of ship shall be in the business. Now this is defining what is the operation of ship, and some treaties do define, some don't define. It talks about business of transportation by ships or air, of transportation of passengers, mail, livestock, goods carried on by the owners or lessees, or charterers of ships and aircraft, including sale of tickets for such transportation on behalf of other enterprise, incidental lease of ships and aircraft, and any other activity directly connected with the transportation. So if you look at it, besides the freight what you collect, there are many host of other activities. If you carry on, may qualify under Article 8, but depends upon the tax treaties. So this is an example of a tax treaty. Now let us look at it, what it says. So Article 8 applies to an enterprise who are engaged in shipping, operation of ship, and profits from the operation of ship in international traffic in a contracting stage with the place of effective management is situated. So when you say place of effective management would mean like what we have under the Indian Act. However, there are some treaties where it is taxed under residence, not poem based, or state of residence in certain cases. Some treaties like USA, UK and Canada, they go by the taxability on the residence basis, not by the effective management. Like, I tell you, we had a case where a company from Israel, the ship is in Hong Kong. India, Hong Kong, there is no treaty. But we had taken a proposition that the Hong Kong treaty is not there, but the Hong Kong business or the company registered in Hong Kong was managed by Israel. And effectively, the India-Israel treaty we applied. And we could get the benefit under the visit tax officer. So you have to look at each treaty and take a decision. What does it mean actually? Now, what do you mean by operation of ship? Could be owned or leased. Ship should be under disposal of the enterprise, and controlling and managing the ship is important. Operation of ship is not defined in some tax treaties like France, Germany, Japan. However, it is defined in some treaties like Singapore, Brazil, Belgium, USA. They are defining what is operation of ship. And expression which is not defined under tax treaty. The question is, can I go to the local law and do it? Here again you will have difference of opinion. Some say like under the tonnage tax scheme, like in the case of Balaji shipping. Balaji shipping, which case I'll take up later on. This was about a slot hire charges. So the question was whether the slot hire charges was in the form of, is it eligible for treaty benefit or not? Now, again if you see, operation of ship shall mean, here is this operating in a ship owned or chartered and includes arrangements such as slot charter. So slot charter in the case of Balaji shipping, the case what I referred to, where the SSC took the argument that under the tonnage scheme, slot charter is covered. So whether the definition under the Income Tax Act can be of use to you by interpreting the treaty provisions. And operation of ship should include actual operation, activity directly connected with operation, and activity incidental. Now, what is covered by operation of ship? Transportation of passengers or cargo by ship or aircraft is covered. Activities directly connected with operation. What is it? Besides transportation of passenger or cargo on ships operated by other enterprises, under code sharing, slot chartering arrangement, or to take advantage of sailing, inland haulage charges, lease of containers, this will be classified as activities directly connected to the operation. And the last is activities ancillary or incidental. Would mean what? Say minor contribution relative to the operation of the ship and which cannot be regarded as separate business. Say if a ship is there and in the ship you have a canteen or a restaurant and you earn income, what happens to that? Or an airline is there and there is a repair facility which they have a sort of a unit for repairing their aircraft, plus they repair the other airline aircraft, and you earn the rental income, earn the income or a service income, whether it will qualify under Article 8 or not. Now these are some food for thought. Tramp shipping more than casual or occasional shipping. Here in the case of Bombay Tribunal, the question arose, what is the meaning of more than casual? And this was primarily because under 172 it talks of occasional shipping, and under the OECD and Indian model it talks about more than casual. So here this vessel had come to India for 7 times in a year, and ultimately the tribunal took a decision that no, you are covered under the province and you are liable for taxation. Now take, this is another example, software development and maintain solely for the purpose of shipping operation taxable as royalty. Or shipping profits, what's the answer? Is it taxable or not taxable? Is it taxable as, can I claim the benefit of treaty or I cannot claim the benefit of treaty? Yes or no? Okay. So in this decision, they said it is in the nature of royalty, but there are other decisions also which said that if it is in connection with this, then it could qualify under Article 8 also. Now, income from security and scanning services provided to other airlines, can this be considered derived from operation of aircraft? Because if you see the other one was operation of ship incidental to the operation, will it qualify there or not? Yes or no? The answer is no, you cannot. So I think you will get a lot of decisions which are contrary to what you believe. Okay, now the other things which can qualify under ancillary or incidental activities, operation of shuttle service from aircraft to, this is just I am giving the thoughts, and as and when you come across the situation, you may have to answer this. Transportation of goods by truck connecting a depot with the port or airport is a depot exclusive for goods in transit hotel. If you have the airline, what does it happen? Interest income for accounts which briefly hold rate collection. So OECD view is different. Protocol to India's paying treaty. Treasury function, whether it is covered. Interest receivable on refund of income tax. As I told you, in the India Israel treaty, refund is covered, and I have we could say in one of our cases that no, it's not taxable under Article 3, though the tax department had deducted taxes. Restaurants, snack shops, etc. operate on ships. Aircraft maintenance on reciprocal basis. So these are the things which perhaps we'll have to look at each case, understand the facts, and then try to apply. Now this is just